Hey guys, so in the previous video, we computed some of the key ratios for this toll road asset. This video, we're going to conclude the entire series. Before we do that, let's just discuss a couple of things, right? So if you look, I don't know if you guys went through these key ratios, but if you look at two numbers, rather one number, this ROC, right? By FY 52, the numbers kind of getting out of whack, right? Like 1690% ROC, not something that most people will particularly believe if they see it, right? So let's think about why this is happening. So for one, uh, so what is ROC, right? It's EBIT divided by total capital employed, which is total debt plus total equity minus cash, because debt minus cash, just to get total capital employed in the business. Now we are paying down debt in the first 10 years. If you look at debt, this figure is going to 0 by year 10. And more importantly, we are taking out all excess cash that the business generates through dividends. So when you think of this equity figure, right, that's coming from the balance sheet, dividends is subtracted from this, right? So the way you compute the next period equity number is previous year's figures plus the PAT plus any equity raise minus dividend. So we're not doing any equity raise in this model, and we're taking out cash. So this number that you see over here, this equity figure, is not growing in line with sales or EBIT, which is in the numerator, not sales, but EBIT. Because of that, this is getting kind of out of whack. So is that acceptable? Is that not acceptable? So let's just think about all of the assumptions, key assumptions that we've used to build this model and see if there's any one or two assumptions that maybe we should think about differently, right? So let's go to the problem statement, right? So we start off, okay, project acquisition date was FY22. End date was 31st March 2052, so a 30-year period. Revenue was, traffic volume was 2 crores. In terms of volume, toll rate was 100. Total revenue when we started off was 200 crores. Now, this number, right, if you think about it, 7% annual growth rate for 30 years is a lot, right? And again, I just want to put a disclaimer out there because I've never covered infra as a space, but just think of it. Think of the Bandra Worli Sea Link, right? After it was constructed, maybe 5 years, 10 years down the line, at some point, the amount of traffic that passes through it will hit a certain level of stabilization, right? I mean, again, it could completely be dependent on where this asset is located. If it's a toll road asset next to, say, an industrial area and there's more factories coming up and there's more trucks going to and fro, maybe this could be the case. But 7% growth for 30 years impute. So let's just compute what that means, right? That means after 30 years, the volume would have gone up almost 8 times, 7.6 times. Volume in terms of the traffic that's going through. Now, that's a tall order, right? I mean, it would depend on so many factors, like I mentioned, the location, number of vehicles that pass through, number of cars that are bought. So if you think about this number, maybe if we thought about it to say, hey, you know what, there's going to be like 7-8% volume growth for maybe 5 years or maybe even 10 years, right? And then it just stops. Let's just see how the model changes. So let's go back. Let's make it, say we start off in FY23. Let's just say by FY27, this goes to 0, right? It stays stable at that rate. How do our metrics change? If you go to key ratios, let's look at the ROC. It goes to, okay, 254%, but that's still like way better off than 1600%, right? And this is also happening because we're taking out a lot of the cash and dividends. So again, what I'm trying to tell you guys is whenever you build a model, right, always ask yourself, what are some of the key assumptions and do some of these assumptions even make sense? Now let's look at some of the other assumptions, right? There was 10% diversion. This is standard. Increase in toll rate. This is standard, right? I mean, it's just going to increase by inflation. This is like a price number. So this makes sense. I don't think there's any sort of controversy in this. OPEX is going to increase. Of course, it's going to increase, right? OPEX always increases because of inflation. Balance sheet. I don't think there was anything special on the balance sheet as well. So I think this number was a little bit of a number that we should think about in more depth when we are building out a model like this. So that being said, let me just go back and change this. Change the linking. And yeah, we have a fully functional three-statement model for a toll road asset. So we start off by building the P&L assumptions for volume and price. We grew them. We spoke about how we should think about this volume growth in more depth. And we spoke about price increases, how that's going to happen. We spoke about OPEX. In this case, we didn't really get into the OPEX because we were not given details on the OPEX, right? We don't know what the OPEX items are. And that's good for us. That saves us time, right? But it could be things like managing the toll road booths, paying salaries, and whatnot, right? So that was that. P&L, there was nothing special. In terms of working capital, so they told us to assume zero NWC. Why will that be the case? There's no inventory, you're not buying. There's no COGS, there's no inventory, you're not buying any inventory, right? Receivables, typically people will pay you upfront. So your receivables days will be close to zero. Payables, they've told us to assume, they've asked us to assume net zero NWC. So if receivables is zero, inventory is zero, payables has to be zero, in which case you're just paying out all of your OPEX. When I say payables, I'm talking about OPEX payables, not the inventory payables, right? You're paying it out on time, so there's no payables over there. We were running maintenance capex every 5 years, which is just to take care of the wear and tear, right? It's a road at the end of the day. On the balance sheet, again, there was nothing special. Like we mentioned NWC, we mentioned PP&E, which is the value of all the amount of money that you've spent to build this road, right? To build this entire asset, plant, property, and equipment. On the liabilities and equity side, we started off with a certain amount of debt, which we were paying down in 10 years. Revolver is just there to pull money if at all our company is losing money. If you change the assumption in such a way that the cash balance is turning out to be negative, revolver is just there to hedge that kind of scenario. Equity is equity, right? We all know about that. Cash flow statement was standard. Debt schedule again was standard. Then we ran like a returns analysis kind of scenario, and we said that, hey, you know what, if we believe that these are the cash flows that this toll road asset is going to generate over the next 30 years, and we want to make 20%, we want to make a 20% rate of return on these cash flows, we're okay paying this much, right? Now, if these cash flows go down for reasons that I mentioned above, maybe the volume growth doesn't come, these cash flows will get compressed, and at 20%, this NPV will come down, right? So that's how it plays into the valuation. We assume zero dividend distribution tax because that was asked of us in the problem statement, and then we computed key ratios. So thank you guys for watching. Hope you guys enjoyed this. I hope you guys learned things that you didn't know before. And if you did, please watch our other series on financial modeling. See you guys over there.
Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.